Okay, well, let's try to figure out what fraud is fraud. Let's say I buy a lot of contracts. Like use random stock. I buy contracts that are options on GameStop. I then publish.
This is just a hypothetical.
It's totally hypothetical because I don't want to. I mean, I don't want to really try to hurt anybody.
Why not? Can't we just ask about Roaring Kitty? I mean, why wouldn't we?
If someone publishes,
Dave, you ask about a specific thing. I just want to talk to your viewers for a second. The SEC runs a civil law enforcement agency. We're a cop on the beat, and you would expect us to investigate where we investigate, but we don't talk about it publicly because we follow the facts and the law, and only if we think there's something to bring in front of a court do we then talk about it publicly.
Hence how hypothetical. Let's say you're Paul Weiss, you're my lawyer, okay? I say to you, look, I want to put up a cryptogram. And it's of a chair leaning up, which we know from video game playing means, come on, this is the ninth inning, get ready. And we know that I'm a person who happens to like the stock of GameStop. This is the signal, come on, get ready. Is this something, hypothetically, that the SEC should worry about?
So, look, again, it's not so hypothetical because you're describing things that are in the public domain and the public is interested in. So, but generally speaking, you have to make sure that you don't mislead the public and that you don't in any way do things in the markets that may be manipulative or misleading. And so that's the key thing in our capital markets.
No, the key thing is if you can cure it with disclosure. This is Brandeis. You know if they disclose that this is something that a call to action, then you can't go after them.
Disclosure is one really key part of our capital markets. When you buy the stock of a company, you expect that they give you full and fair disclosure. That's, by the way, not what you're getting right now in this crypto field. So I just, cautionary tale there. That disclosure. But disclosure doesn't necessarily protect a bad actor if they're manipulating a market. You can't just simply disclose that away, particularly if you're misleading the public.
Not cured. Disclosure not cured. Very good.
Can I ask a broader question about the public markets? Because it comes up a lot now, in particular sometimes from those who are actually very active in these very large private markets. But the idea that our public markets are broken, that we have 7 companies that represent 30+%, for example, of the market cap, that we have far fewer public companies than we did 10 or 20 years ago. I'm curious how you think about that and whether you agree or disagree with those who would argue that the public markets don't work the way they should.
Look, I believe deeply in competition, and we in the U.S. benefit from very large capital markets, which are 5 times our banking system. $23 trillion banking system, $110+ trillion capital markets. Not Europe, not Asia, that competition. But I also believe in competition between public markets and private markets. Maybe it's because my dad had a small business of 30 people. Maybe it's because I did work at Goldman Sachs that when I was there, and Jim, you were there.
Yeah.
You were on a different floor.
No, I wasn't on a different floor. I was on a better floor. Higher paid.
Don't lose track here. Don't lose track.
Sorry,
but I really do think that public and private can compete with each other and benefit the American public. The key is to make sure that there's standard rules, that people get the proper disclosure if you're investing in something, that basic bargain. They get full and complete information on material aspects of the companies, but also that the capital markets, like this here, are operating free of fraud and manipulation.
But what about the private credit markets? I mean, they've grown enormously, for example. There is, you could argue, a lack of transparency, but that may go along with it because you have typically a contract between one borrower and one lender.
But there what we have is we have competition between private provision of credit and the banks. And generally, that's a competition that we, promote. Now, at the same time, do we have to make sure the investors in those private credit funds are getting, the disclosure they need and they're not getting misled and so forth?
You have a really active following on social media. When you posted yesterday you'd be on, tons of replies. And
thanks. Did it help your viewership?
We'll see.
Well, that's why we're talking.
The 2 issues that I saw they wanted to learn most about was the timing of the Ethereum ETF approval and
I think that happened a week and a half ago.
And what pressures you felt to make that happen. And then second would be trading patterns among members of Congress. Can you talk about the two?
We have in the U.S. already a way that you can invest in various underlying securities and underlying commodities called exchange-traded products. In January, we approved an exchange-traded product on Bitcoin. And about a week and a half ago, similar filings to list on the New York Stock Exchange, list on NASDAQ and the like, exchange-traded products on Ethereum. Ethereum had been traded on the Chicago Mercantile Exchange futures for 3+ years, and the staff looked at that closely, and that was approved. Now, the underlying exchange-traded products still need to go through a process to have the disclosure about that, and that will take some time, but they're working on that right now.
And how about congressional trading?
Well, look, everybody in the markets, 330 million Americans, should understand that you have to play by the rules of our capital markets. And one of those things is that when you trade, you don't trade on what's called inside information from a company that is not made disclosed to everybody else. But the same rules apply to all of us to make sure that we do right by the law.
So we could conceivably investigate someone for inside information who's in Congress.
Well, historically, that has happened in the past.
Okay. Now, Polkadot, Cordana, Cosmos, Immutable, Ronin, Bonk, Osmosis, Sushi Swap, My Neighbor Alice have all traded millions. I'm talking about millions of dollars this very morning. Now, should we have a Sushi Swap, maybe an ETF, or the proprietary kind? Just I would think that Bonk is a natural, and Osmosis. These are trading Gary, these are millions of dollars. These things are traded. Shouldn't we have it? Shouldn't we have some sort of product?
Let me say something more broadly about the crypto markets. Right now, without prejudging anyone, these tokens, whether they're the ones Jim listed or other tokens, have not given you the disclosures that you not only need to make your investment decisions, but also that are required by the law. It's a basic concept in our securities market. We, the SEC, tomorrow are turning 90. Happy birthday, SEC, 90. And what President Roosevelt did is he created this commission to oversee that you, the investors, get disclosure. And in the crypto markets, they aren't giving you that disclosure. And secondly, that exchanges like here, this floor, the New York Stock Exchange, get properly regulated to protect against fraud and manipulation, and they don't trade against you. And these crypto exchanges, Jim, are doing things we would never allow this New York Stock Exchange to do. Our laws don't allow you to trade against your customers. And so you've seen the bankruptcies in this space, and there are some of the most leading lights in this field are either in jail, about to go to jail, or waiting extradition.
Okay, well, it's a suboptimal situation for them, but I'm looking at the...
But it's a suboptimal situation for investors. You're investing in a field right now that you're not getting the proper disclosure.
I agree, there's securities for people actually I know. I mean, their names. And there's nothing... You know that too.
That's funny, yeah.
I mean, some people even in this room have their names attached to a coin for no reason. Makes no sense.
I'm sorry, you guys have coins?
No, we don't.
There's a Cramer coin?
There should be, but there isn't.
Yes, there is a Cramer coin.
I hope it's properly registered.
Well, I wasn't going to bring it up because now it's a pump and dump. Like, wow, Cramer coin. I was not going to bring it up, but there you go.
Chair Gensler, wait, we have only a little bit of time
the
left.
SEC versus Ripple Labs.
Ripple.
Right, Dave, what do you want to ask?
There you go. I've got the floor.
Thanks.
What I want to ask is, I used to text a lot of my sources, and now they say, please don't text me at that number because we've already been fined by the SEC. It's the personal use of personal devices for work. Many describe it as a money grab. It's tens of millions in fines you guys have leveled at this point.
It's actually something quite different,
and
Dave.
It frustrates a lot of people who say, come on, this is ridiculous, especially during COVID. How could you have expected us not to use our personal devices for some work?
Dave, it's very simple. For the SEC, for your cop on the beat to do its job, companies need to keep proper books and records. And this goes back to the 1930s. This is not a new thing. And when banks or brokers, investment advisors are not keeping those books and records properly, then we can't be that proper cop on the beat. But what's more, the broker-dealer can't actually manage its risk. It can't properly manage its risk. So even when I was on the Wall Street, and Jim and I were both at Goldman Sachs, we knew that they actually recorded the phone calls on the, and they kept the books and records. That's what this is. And we found a lot of the big broker-dealers and banks were not doing that. They were doing off-channel communications. And I'll tell you this, when I was served President Obama over at the Commodity Futures Trading Commission, one of the big things that we saw, there was manipulation in the foreign currency markets, and people were doing it in off-channel communications.
All right, well, look, I hope you'll come back, because it's a delight to have you.
Let's start with GameStop and Keith Gill. If Keith communicated privately with other people prior to buying his GME position and posting online, the SEC would likely consider that insider trading or market manipulation. But if Keith did not say anything privately about his GME position before posting online, then that is not market manipulation. Based on what we can see right now, it appears Keith simply bought GameStop stock and some call options, and then openly posted it online for everyone to see at the same time. And if that, along with posting some memes, is all that he did, then that is not market manipulation. Not in the slightest. I find it astounding how Gensler claims that proper disclosure is so important, but yet members of Congress can file their trades months, even years late, and they are not held accountable at all. Members of Congress actively trade on insider information in the stocks of companies they legislate, and regulators do absolutely nothing about it. But if a guy transparently shares his position online for all to see and posts some memes on social media, then regulators investigate that. But they don't investigate members of Congress who trade on insider information regularly. Absolutely insane. I really wish the host had asked Gensler about the implications of a brokerage removing a client simply due to the position that client holds. If the Wall Street Journal's reporting is true about E-Trade considering removing Keith from their platform, then that is just insane. A client should not be removed from a brokerage simply due to the position that client holds and their presence on social media. If E-Trade were to remove Keith from their platform, it would have broad implications not just regarding the securities market, but also regarding Keith's First Amendment rights. If E-Trade does remove Keith, I would expect to see a mass exodus of individual investors leaving E-Trade and a subsequent lawsuit filed against E-Trade by Keith. In my view, E-Trade would be better off leaving Keith alone and letting him trade freely on their platform. If the number of call options Keith holds is the problem, then maybe someone should not have sold that many calls in the first place. It's not Keith's fault if broker-dealers fail to properly manage their risk. At the end of the day, what individual investors want is simple, and nothing we're advocating for is beyond the realm of reason. Individual investors want a free, fair, and transparent stock market. We want large institutions to be held accountable for their actions. We want individual investors to have access to the same real-time data from exchanges' better private feeds, which is currently only available to the large firms on Wall Street. We want short sale data to be reported in real time. We want an end to excessive amounts of failures to deliver, and we want entities who fail to deliver on their obligations to be held accountable. We want an end to payment for order flow due to the insane conflicts of interest it creates. There's a reason why so many other countries have already banned it. We want the exchanges to be not-for-profit utilities as they once were. The exchanges becoming for-profit ventures has created so many conflicts of interest at the expense of individual investors. We want increased competition among market makers, and we want all of individual investors' orders to be routed directly to lit transparent exchanges rather than opaque alternative trading systems known as dark pools. Ultimately, it's simple. What we want is a stock market that offers a truly level playing field for all investors. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free, and you can always change your mind. Thanks for watching, and hopefully I'll see you in the next video.